Before anything else begins, I want to ask you something important about silver and investing, and I want you to answer honestly in the comments because it helps everyone watching understand the global picture. Do you believe silver will break $100 per ounce soon, or do you think the market will crash first? Write your silver price prediction and the country you are watching from right now. This conversation matters because the data we are about to examine affects investors, savers, and anyone paying attention to the global financial system. Now pause whatever else you are doing for a moment. Close the extra tabs, silence the phone. Give this your full attention, because what you are about to hear is one of the most concentrated collections of silver market information presented in a single analysis. Every number matters, and every development connects to a bigger story unfolding right now in real time across the global commodities market. At this moment, silver is testing the $90 per ounce level again. This marks the third consecutive positive trading session. Over the last 12 months, the metal has climbed roughly 161% year over year. But the price movement itself is not the most important development. What matters even more is what has been happening behind the scenes in the physical silver market. In the last 7 days alone, something extraordinary occurred inside the COMEX vault system, something that should be dominating financial headlines everywhere but strangely is not receiving the attention it deserves. A massive withdrawal of physical metal just took place. In a single week, approximately 33.45 million ounces of physical silver were removed from COMEX vaults. That represents about 26% of the entire registered inventory disappearing in only 7 days. Think about that for a moment, because the scale is enormous. We are not talking about paper contracts being shuffled between accounts or internal accounting changes inside the exchange. This was real metal leaving the vaults. Bars physically removed, loaded for transport, and delivered to entities that requested the metal. When over 1/4 of the deliverable inventory leaves in a single week, it forces analysts and traders to ask a serious question about the stability of the pricing system built around that inventory. To understand why this matters, you have to understand what registered silver in COMEX vaults actually represents. Registered silver is the portion of metal that is specifically designated and available for delivery against futures contracts. In other words, it is the physical backing that supports the entire paper trading system. When traders around the world look at the COMEX price and see silver trading at around $88 or $90 per ounce, the underlying assumption is that there is enough physical metal stored in those vaults to fulfill delivery obligations if buyers choose to take possession. That assumption is the foundation that keeps the pricing mechanism credible. During early 2026, that foundation has been shaken more than at any time in modern market history. By the end of February, registered inventories had fallen to roughly 86.1 million ounces. Compared to levels seen only a few months earlier, that represents a decline of about 31%. That reduction alone would be significant, but the timing makes it even more important. The March delivery cycle currently underway has been described by several market analysts as a stress test for the global silver pricing system. Delivery demand in this cycle represents more than 60% of the remaining registered inventory. Let that number sink in. More than 60%. If every contract holder who has the right to demand physical delivery actually decides to exercise that right, the system has almost no room for error. The vaults would be operating with extremely thin margins, essentially running close to empty. One of the most striking observations about this situation came from a research analysis that summarized the entire issue in a single sentence. The analysis explained that the system had always relied on a simple assumption, that not everyone would request delivery at the same time. In early 2026, that assumption began to fail. For decades, the paper futures market functioned smoothly because most participants traded contracts for price exposure rather than physical metal. But if even a portion of those participants start requesting the metal itself, the structure supporting the paper price becomes strained very quickly. Another statistic highlights the magnitude of the imbalance. Analysts examining the market have estimated the ratio between paper silver contracts and available physical metal at approximately 21-1. That means for every single ounce of physical silver available for delivery, there are about 21 ounces represented by paper contracts. As long as most participants treat those contracts as financial instruments rather than claims on metal, the system continues operating. But if confidence shifts and more traders demand delivery, that leverage ratio becomes extremely important. The exchange has already attempted to respond to rising volatility. One of the primary tools used by exchanges during periods of speculation is raising margin requirements. In mid-February, the CME increased silver futures margins from 15% to 18%. The result was immediate. Silver experienced a sharp single-day decline of around 10%, marking one of the largest daily drops since 2020. The margin increase achieved its short-term objective by forcing leveraged traders to reduce positions and triggering a wave of liquidations. However, there is an important limitation to that strategy. Margin adjustments can influence the paper price by reducing speculative activity, but they cannot create physical metal. They cannot refill the vaults or replace ounces that have already been withdrawn. Raising margins addresses the financial side of the market, while the underlying challenge is physical supply. Until additional mine production enters the market, the basic arithmetic remains unchanged, regardless of how many times margin levels are adjusted. And bringing new mine supply online is not a quick process. From initial exploration to full production, new mining projects typically require 7 to 12 years. That long development timeline means supply cannot respond quickly to sudden increases in demand. Even when a promising discovery occurs, the path from drilling results to commercial production involves resource estimation, environmental studies, permitting construction, and infrastructure development. This brings us to an announcement that arrived recently and has drawn attention across the mining industry. Pan American Silver, one of the largest primary silver producers in the world, released exploration results from its La Colorada mine in Mexico. The drilling campaign conducted between November 2025 and January 2026 covered approximately 17,774 meters. During that exploration work, geologists identified at least 4 previously unknown veins containing high grades of silver, along with associated gold and base metals. The assays reported from those drill holes were particularly impressive. In about 40% of the holes, silver grades exceeded 1,000 grams per ton. For context, the average grade of a typical silver mine globally is usually somewhere between 150 and 200 grams per ton. That means these new intercepts are roughly 5 to 7 times richer than the global average. Discoveries of that quality are rare and are considered exceptional within the mining sector. Geologically, the new veins extend roughly west-northwest and collectively create a strike length of about 2,500 meters connecting 2 previously identified structures known as Cristina and San Geronimo. According to company statements, the discovery could significantly expand the mineral resources associated with the La Colorada property. Christopher Emerson, the company's senior vice president responsible for exploration and geology, confirmed that these results support a revised development strategy focusing on higher-grade zones within the deposit. The company has already begun expanding its exploration work. A new exploration crosscut has advanced around 170 meters on level 5 and 88, and another crosscut on level 448 is being developed to improve drilling access. Continued drilling campaigns are expected to refine the understanding of these structures over the coming months. But even discoveries like this highlight the long timeline involved in expanding supply. The first detailed mineral resource update incorporating these new veins is expected later in the year. After that, additional planning and engineering work will still be required before production could eventually increase. In the meantime, the broader silver market continues facing a structural supply deficit that has been developing for several years. While new discoveries are encouraging, they cannot immediately close the gap between global demand and available supply. As a result, the dynamics shaping the silver market today are being driven by a combination of tightening inventories, rising industrial demand, and growing investor attention. And those forces are exactly why analysts across the financial world are now publishing dramatically different price forecasts for where silver could go next. The range of price forecasts currently circulating among major banks and independent analysts is one of the clearest signals that the silver market has entered an unusual moment in its history. Rarely do you see such a wide spread of expectations from institutions that normally cluster around similar forecasts. Yet right now, the predictions stretch from deeply bearish warnings of sharp corrections to extremely bullish projections that envision a dramatic repricing of the metal within a relatively short period of time. Let's begin with the more conservative institutional estimates. One of the major global banks has projected an average silver price of around $81 per ounce for the full year of 2026. Their analysis assumes continued supply tightness and strong industrial demand, which together support higher prices compared with previous years. Interestingly, however, this forecast is actually lower than current trading levels. That means according to their baseline scenario, silver could remain volatile while ultimately averaging slightly below the levels currently seen in the market. Within the same analysis, the bank's strategist also warned that if speculative positions unwind before the underlying fundamentals fully catch up, the metal could temporarily fall toward $50 per ounce. That scenario would represent roughly a 43% decline from current levels. Such a drop would not necessarily invalidate the longer-term supply deficit thesis, but it would illustrate how violently silver can move during periods when leveraged positions are forced to unwind. Now contrast that cautious outlook with another forecast coming from a different major financial institution. Their metals analyst has published a target range between $135 and $309 per ounce for the year ahead. At the upper end of that projection, silver would more than triple from recent prices. This prediction is based primarily on the expectation that the gold to silver ratio will compress significantly while supply constraints continue tightening. According to that thesis, the imbalance between available physical metal and global demand could eventually force a substantial upward repricing. Between those two institutional extremes sits a wide spectrum of independent analysis. Some researchers see the metal approaching $100 relatively quickly if key resistance levels are broken. Others outline a sequential series of targets extending much higher. One widely discussed model proposes that silver could first move toward $111, then potentially reach $146, and eventually climb to $185 within roughly 12 to 18 months if the current supply deficit persists. Another analyst, known for studying long-term momentum patterns, describes the potential move as a quantum leap in pricing. His view is that decades of accumulated pressure within the market could release rapidly once certain structural thresholds are crossed. Under that framework, silver might surge into the $100 to $200 range within a much shorter time frame than most investors expect. Still, another projection suggests that the rally which carried silver from roughly $40 to over $120 earlier represented only the first phase of a much larger cycle. According to that perspective, the metal could eventually reach a range between $240 and $260 before the cycle completes. Whether or not such aggressive forecasts materialize, the mere fact that respected analysts are publishing them demonstrates how dramatically expectations have shifted in the last few years. What is especially remarkable is that these predictions exist alongside the memory of a recent all-time high. Earlier this year, silver briefly touched approximately 121.62 per ounce before experiencing a substantial correction. That high was close to levels predicted in advance by some analysts, highlighting how rapidly the metal has already moved compared with its long-term historical range. The existence of forecasts ranging from $50 on the bearish side to over $300 on the bullish side tells us something important. It means there is currently no clear institutional consensus. Instead, the market is confronting a set of conditions that could lead to dramatically different outcomes depending on how certain variables evolve. To understand those possible outcomes, we need to examine the technical structure of the market. Right now, silver is trading around $88 to $89 per ounce and repeatedly testing the psychological $90 level. Over the past several weeks, the price has been moving within a consolidation channel that began forming earlier in the year. The lower boundary of this channel sits near $70 per ounce. That level corresponds to the lows established between December and February following the sharp correction from the January peak. The upper boundary is the resistance zone between roughly $90 and $94 that has been tested multiple times during recent sessions. In the middle of this range lies an important level around $80. This midpoint is not arbitrary. It aligns closely with the highs recorded late in 2025 and is reinforced by the presence of a widely followed moving average. When a price level combines previous structural resistance with a major technical indicator, traders often treat it as a key support area. If the metal pulls back from current levels, many analysts expect buyers to appear near that $80 zone. A sustained break below it would weaken the current structure and shift attention toward the lower boundary of the consolidation range at $70. Beneath that area, the next major technical support lies closer to $60, where longer-term trend indicators converge with previous breakout levels. On the upside, the immediate obstacle remains the $90 to $94 resistance band. Markets often test such zones multiple times before either breaking through or reversing downward. If silver were to close decisively above $94 on a daily or weekly basis, something notable would appear on the chart. Between $94 and the previous all-time high near $121, there is relatively little historical trading activity. Because silver has not spent significant time trading in that region, the chart does not contain many prior price structures that could act as resistance. In technical terms, that means the path upward could become comparatively clear if the breakout occurs. A move from $94 back to $121 would represent roughly a 29% gain. Considering that the metal already rallied more than 160% over the previous year, such an extension would not be unusual within the context of silver's historical volatility. Precious metals often accelerate rapidly once new highs begin attracting momentum traders and institutional capital. Several technical indicators are also being monitored closely by market participants. One model places the current mean value around $83.80, a level that the market is trading comfortably above. Remaining above that mean generally signals continued bullish momentum. Other calculated resistance points sit near $88, $91.63, and around $91.60, where different harmonic and statistical measurements converge. If prices can close above the higher of those levels consistently, certain models interpret it as a transition into a new fractal structure where previous resistance becomes support and higher targets begin opening on the chart. While Western futures markets often receive most of the attention, another development has been quietly gaining importance. In Shanghai, the price of physical silver has been trading near $87 per ounce, even while Western futures prices fluctuate slightly below that level. The divergence is driven largely by strong physical demand from industrial buyers in Asia. China's manufacturing sector consumes large quantities of silver for electronics, solar panels, and advanced technology components. When physical demand rises strongly in those sectors, local markets can begin influencing global price discovery. Some analysts now believe Eastern trading hubs may increasingly shape future price movements rather than simply following Western futures exchanges. Gold's recent performance also plays a role in the silver story. The gold price has climbed above $5,400 per ounce, more than doubling over the previous year. Historically, silver tends to amplify the direction of gold's movement because it functions both as a precious metal and an industrial input. When gold rises strongly, silver often follows with larger percentage moves. The relationship between the two metals is often measured using the gold-to-silver ratio. Although that ratio has declined from extremely high levels seen in previous years, it still suggests potential for silver to outperform gold if it continues compressing toward historical averages. Even if gold prices stabilize, a narrowing ratio alone could imply higher silver valuations. All of these factors together create a complex environment where the market must balance powerful bullish forces with equally real risks of short-term volatility. The tightening supply situation, the inventory withdrawals from exchange vaults, and the growing industrial demand point toward upward pressure over the long term. Yet the speed of recent gains, the presence of leveraged speculation, and the possibility of policy interventions mean corrections can occur suddenly. Understanding both sides of that equation is essential for anyone trying to navigate the market responsibly. In the final part, we will examine the full bullish and bearish arguments side by side, including the structural supply deficit, the risks of economic slowdown, the influence of industrial demand, and the broader forces that could ultimately determine where silver prices head next. Before we move toward the final conclusions, it is important to pause and look at the entire picture from both directions. The information discussed so far strongly suggests that silver is entering a period of major structural change. However, responsible analysis cannot focus only on the bullish argument. Any serious investor or market observer must also understand the risks, the weaknesses, and the scenarios where the market could move sharply in the opposite direction. When the data overwhelmingly points toward one narrative, that is precisely the moment when discipline matters most. First, consider the speed of the rally that has already taken place. Silver increased approximately 161% in just 12 months. Earlier this year, it reached roughly $121.62 before falling dramatically toward the $70 area during a sharp correction. That decline erased more than $50 from the price, representing a drop of over 40% from the peak. The move happened quickly and reminded investors how violently this market can behave. One of the triggers behind that correction was a margin increase implemented by the exchange. When leverage requirements rise suddenly, traders who are holding large positions using borrowed capital may be forced to close those positions quickly. The resulting liquidation can cascade through the market as one sell order triggers another. Because silver futures are widely used by leveraged traders, margin changes can produce rapid price swings even when the long-term fundamentals remain unchanged. If the price approaches $95 or even $100 again, there is always the possibility that another margin adjustment could occur. Should that happen, the market could experience a repeat of the forced selling that pushed prices down earlier in the year. Being correct about the long-term direction of a commodity does not protect anyone from short-term volatility if leverage is involved. Another risk comes from the positioning of speculative capital. Some analysts have warned that if speculative enthusiasm cools before the physical fundamentals fully assert themselves, the price could temporarily fall toward $50. Such a scenario would not necessarily mean the structural deficit disappears. Instead, it would reflect the reality that markets sometimes overshoot in both directions before settling at levels that better match underlying supply and demand. The current consolidation channel between $70 and $94 also carries technical implications. Consolidation patterns are periods where buyers and sellers battle for control of the trend. Eventually, the price breaks out, either upward or downward. If the breakout occurs to the downside rather than the upside, the next support area lies near the 200-day exponential moving average, around $60. Beneath that level, historical structure near $55 provides another potential floor. From current levels, a decline into that region would represent a drop of roughly 35 to 40%. While such a move might not destroy the long-term bullish case, it would be extremely painful for anyone who entered the market using excessive leverage or who purchased near the top of the recent range. Industrial demand introduces another layer of complexity. More than half of global silver consumption comes from industrial applications. That demand includes solar panel manufacturing, electronics production, electric vehicle components, and advanced data infrastructure. During periods of economic expansion, those sectors consume increasing quantities of metal. But if global economic activity slows sharply, industrial consumption can also decline. A severe recession or disruption to global trade could delay large infrastructure projects and reduce manufacturing output. Solar installations might slow, electronics factories could temporarily cut production, electric vehicle manufacturing might adjust to lower consumer demand. In such an environment, industrial silver consumption could decline for a period of time, placing downward pressure on the price, even if long-term trends remain supportive. Another concern occasionally raised involves technological substitution. Over the past decade, solar manufacturers have already managed to reduce the amount of silver used in each photovoltaic cell by more than 70%. Rising prices create an incentive for companies to continue researching ways to use less of the metal or potentially replace it with alternative materials. At present, no substitute matches silver's electrical conductivity and efficiency. Yet the financial motivation to develop alternatives increases as the price climbs higher. These risks form the bearish side of the argument, and ignoring them would be a mistake. But now consider the forces pushing in the opposite direction. The most powerful factor is the ongoing supply deficit. For several consecutive years, global demand for silver has exceeded the amount produced by mines and recycled from existing sources. Estimates suggest that the deficit for 2025 alone reached approximately 117.7 million ounces. If projections for 2026 hold true, that would mark 6 consecutive years in which demand surpassed supply. Cumulative deficits over multiple years gradually reduce above-ground inventories. Unlike some commodities that can rapidly increase production, silver supply is difficult to expand quickly. Roughly 70% of global silver production comes as a byproduct of mining other metals such as copper, lead, and zinc. That means the decision to increase silver output often depends on the economics of entirely different metals. Primary silver mines are relatively rare. Even when new deposits are discovered, the development timeline can stretch close to a decade before meaningful production begins. The recent discovery of additional high-grade veins at the La Colorada mine illustrates this reality perfectly. While the grades exceeding 1,000 grams per ton are impressive, the process of translating those discoveries into actual supply will still require years of planning and development. Meanwhile, demand continues expanding across multiple sectors. Solar power capacity is increasing rapidly around the world as governments invest heavily in renewable energy infrastructure. Data centers supporting artificial intelligence require enormous electrical systems where silver's conductivity becomes valuable. Electric vehicles, 5G telecommunications networks, advanced medical equipment, and defense technologies all rely on components that incorporate silver. These demand drivers are not short-term fads. Many are supported by legislation, long-term capital investment, and technological necessity. Once billions of dollars are committed to building energy infrastructure or digital networks, those projects typically continue regardless of short-term economic fluctuations. Another important factor involves geographic shifts in market influence. Physical trading hubs in Asia are increasingly active in determining the price of precious metals. When strong physical demand appears in markets serving billions of consumers and the world's largest manufacturing base, the impact can eventually override paper trading dynamics elsewhere. If physical premiums remain higher in Eastern markets, pressure builds for Western futures prices to adjust accordingly. The range of price predictions reflects these conflicting forces. Conservative institutional estimates still cluster around levels near $81 on average. More aggressive forecasts extend far higher, with some analysts projecting prices above $185 or even $260 under extreme supply tightening scenarios. When predictions span such a wide range, it indicates that the market is navigating conditions rarely seen in previous decades. Technically, the situation remains balanced but tense. Silver continues consolidating between $70 and $94. A breakout above the upper boundary would open a clear path toward the previous all-time high near 121.62 because little historical resistance exists in that region. A breakdown below $70 would instead target the deeper support zones near $60 and $55. For investors and observers alike, the most important lesson is the need for preparation. Silver is capable of extraordinary movements in both directions. Earlier in the year, it lost more than 40% within weeks, and also recorded a 10% drop in a single day after a margin adjustment. Volatility of that magnitude demands discipline. Anyone participating in the market should clearly understand their time frame and their tolerance for drawdowns. Trading short-term fluctuations requires a completely different mindset from holding a position based on a multi-year structural thesis. Position sizing becomes critical because excessive exposure can turn normal volatility into financial stress. Every investor should also have a clearly defined thesis explaining why they are involved in the market and what evidence would cause them to reconsider. Without that clarity, decisions become reactive rather than strategic. Markets reward preparation and punish emotional responses. Ultimately, the silver market today stands at a crossroads shaped by tightening supply, expanding industrial demand, and evolving global trading dynamics. Whether prices surge dramatically higher or experience further corrections along the way will depend on how these forces interact in the months ahead. What matters most is understanding the data, recognizing the risks, and approaching the opportunity with careful judgment rather than blind enthusiasm.